Canada is this close away from going into a recession, and it seems like the government is in absolute denial. Welcome back to the channel. Welcome back to another video, everybody. Before we get into it, I do want to encourage everyone to smash the like button, subscribe if you haven't yet already. It does really help the video grow as well as the channel. And just a soft reminder that this is indeed the extra channel, so I may look familiar from other ones, but I'd super appreciate it if you guys showed this channel the same love and support that you do all of the other channels. We're taking a look at a Bank of Canada update and how it's just not good. They're anticipating massive jumps in mortgage rates and interest rates, and it seems like Justin Trudeau, Crystia Freeland are, parading around Canada in denial, and they're borderline lying to Canadians. But before I get into that, I do want to remind you that you can get one of the matching stickers like I have on my microphone. Wacko Trudeau has to go, limited time, limited edition. Get them down in the description below or the pinned comment before they are all gone. Now let's get into this video here. So this is a clip that I shared recently on Mr. Sunshine, the main channel, but I do want to show it here and make a dedicated video about what's happening with our finances in Canada. So this is only the 24-second clip. It has 1 million views, folks. It has 1 million views in one day. Bank of Canada, brace yourself for a financial crash. Some indicators of financial stress have risen. At the same time, the valuations of some financial assets appear to have become stretched. This is the actual Bank of Canada video. It's 1 minute and 11 seconds. We're going to watch this full clip just to get a little bit more context. Here we go.
Over the past year, the risk of recession has diminished in Canada and globally. Inflation in most countries has come down, and inflation targets are in sight. However, there could be volatility in markets as expectations shift about when and by how much central banks will lower their policy rates. And there continue to be important geopolitical and economic risks on the horizon. Against this backdrop, households and businesses continue to adjust to past interest rate increases. Some indicators of financial stress have risen. At the same time, the valuations of some financial assets appear to have become stretched. This could increase the risk of a sharp correction that could generate system-wide stress. The recent rise in the use of leverage in non-bank financial institutions could amplify the effects of such a correction. What's most important is that to properly manage risks, financial system participants need to remain proactive, and financial authorities need to remain vigilant.
So that's not a very good update, folks. I don't know about you guys, but that sounds like we're going to be pretty much screwed because our government is mismanaging money and they don't know what the hell they are doing. But let me know down in the comments what your interpretation was of that. From my understanding, Bank of Canada, anyone who's on variable mortgages is screwed in the next several years, like absolutely screwed. I think they said the rates could rise as much as 12%, and it's currently like 5 or 6%. That's not good. That's not good, all right? I believe that's what I've read previously. And then also, I mean, our inflation, if that's the case, if interest rates are going up, the only way that they can combat all the money that they printed is by doing this. But they've been doing it slowly instead of at once. And that's not necessarily the problem that people have. It's the lying. It's the lying about it, the gaslighting. Yeah, no, we're great. We're better than ever. We're better than ever, folks, especially when you got videos like this come out that more jobs have been created in Canada in April, and it seems like we're back on track. It's just lies. It's all fibs.
Now, it's nice to have you with us this morning, and we lead our coverage this hour with the latest Canadian jobs report and a hot jobs report. At that, Canada's economy added 90,000 positions in April. That blew away Bay Street expectations for a gain of 20,000 jobs. In addition, the unemployment rate, which economists had thought might tick up to 6.2%, remains steady at 6.1%. Now, while this is a strong rebound from what we saw in March, there are some reasons for caution. The job gains were driven by part-time positions. In addition, the pace of hiring failed to keep pace with our rising population. And on wage growth, compensation is rising at the weakest pace in 10 months. All this to say, the door seems to still be open for the Bank of Canada to consider cutting interest rates starting next month. Most economists currently expect the bank to lower its policy rate by 25 basis points on June 5th. That would mark the start of an easing cycle if it happens. This jobs report today is the last one before that rate decision. So beyond this data, perhaps the inflation report we are waiting on later this month will likely be closely monitored on the street. Against that backdrop, we have full coverage of the job story this hour. Joining us here in studio, Don Desjardins, Chief Economist at Deloitte Canada, as well as Earl Davis, Head of Fixed Income and Money Markets at BMO Global Asset Management. Always nice to see both of you. Thanks for joining us. Don, your reaction to the jobs number?
Well, that was a wow. Certainly it was a lot stronger, as you said. Now, you also pointed out it was part-time jobs, which accounted for over half of that. But it was private sector jobs, which has been
That's a key part that they just seem to glaze over, right? 90,000 jobs in April. Over half of them, though, are part-time, and we're going to conveniently leave that out of the original report.
We've seen a lot of public sector jobs being created. Public sector up a little bit too, but private overtaking it this time. I think what's interesting is that youth also saw a big increase. And that's been a sector, a part of the labor market that's been really suffering. Having said that, the youth unemployment rate is, it's close to 13%. So it is still extraordinarily high. So all told, as you say, it's a big wow at the top, but then you look through and maybe not as strong as all that.
Okay, and Earl, how would you characterize the jobs market right now?
Yeah, well, it's an outstanding number. I like looking at this in the context of the U.S. If you say the U.S. is approximately 10 times larger than Canada, this would be the equivalent of a 900,000 monthly gain. That would be on every news headline. And not only would they stop talking about eases, they would start talking about hikes. But in Canada, to your point, like you said, there was this, I wouldn't say it was led by part-time jobs. There was a significant portion of it, more than a majority, 50,000, but there were still 40,000 full-time jobs.
Yeah, led. Hey, buddy, it's not a participation world, all right? You don't, if something is in the lead, if something has a majority, that's leading. So it was led by part-time jobs. The denial of that is just delusionary.
The total number expected.
Yeah. Okay. So what's our takeaway here, Don?
Well, I think, some pockets that had been suffering or underperforming, we're starting to see some pickup. And the hospitality sector in particular saw a big increase, I guess, as we get into the summer season.
Yeah.
But when you look at it year over year, hospitality is still basically flat, so where it was in April 2023. But we also did see, professional services picking up, scientific services. So that's good. That's the area of the economy where you're going to have some high-paying jobs. Good growth there, I think, is encouraging. As you said, the wage growth did moderate, but it's still pretty hot at 4.7, 4.8%.
So, Earl, where should the street land on something like this? And, I think we live next to the U.S., so it's hard not to embrace some of what's being discussed there. To your point, a week ago, we had a weaker than expected American jobs report. It started getting people talking once again around the U.S. cutting interest rates. At that time, heading into this Canadian jobs report, people were saying Canada's a different beast and things are showing signs of cooling here. And if inflation pressures are easing, it's starting to seem like whether the U.S. cuts rates or not, Canada is on pace to be cutting interest rates come June. When you have a hot jobs report like this, what does the Bank of Canada make of it?
Now, a lot of things to dissect there. So let's start with the first one. I think this makes it easier for the Bank of Canada to start in July or even September, which is my base case.
And harder in June.
And harder in June. Having said that, we do have one extremely important number, which you mentioned, which is the CPI number. Unfortunately, our forecasts actually anticipate higher than expected. We're seeing a turnaround on the monthly numbers in CPI, and we expect actually higher than expected. If you do get higher than 2.7%, which year on year, which is what the market's expecting for CPI, I think that pushes it to at least July. Another thing, and this is why I believe the jobs number is strong, and always remember, this is because of the resilience of the U.S. When the U.S. surprises to the upside economic-wise, we benefit. It's a lag, but now we see it and we benefit. So it's important to remember there's a high correlation between interest rates in Canada and U.S., which just means U.S. has so much influence over and beyond what we see in our own economic data.
And Don, if for now we have a hotter than expected Canadian jobs report, and if the inflation numbers, I don't want to put words in Earl's mouth, but if they prove sticky, What is the reason why we're even talking about, forget about pushing out rate cuts from June to July. Why are we talking about cutting rates right now? What is the concern for Canada's economy?
Well, certainly, I think, if we do see any flagging of the economy, and, you looked at the January GDP, for example, very strong, and February a little less, and March really quite flat. So it isn't all smooth sailing, I don't think, for the economy. And let's face it, the labor numbers are very bumpy.
Yeah.
So, we could bump.
And that's exactly why you have Canada, or our government, that's investing in all of these plants to push more numbers into the labor market. It's very strange. For the first time in, at least since I've been really paying attention, this seems like instead of actually trying to fix the economy, to fix the job sector, to fix interest rates, they're just trying to make it look good on paper. And I'm still wrapping my head around that. Is that to get more lending power from other countries? Is that to look better for like this World Economic Forum? I don't understand it, but it doesn't matter how much you lie to people. You can just go downtown. You can just go to any city, any town, walk down the street, go to any business owner and say, is business booming? Are you hiring people? Are people wanting to work here? Is the job turnover rate, is it increase? Is it decrease? Like, what's happening? And it's just shite across Canada. It's really, really bad. And it doesn't matter how many panels like this they do, how many times they try to fudge the numbers. 90,000 jobs were created in April of 2024 here in Canada, but they conveniently leave out that over 50% of them are part-time jobs. That's great. I mean, that's good, but people need full-time jobs. Then that's what you need to boost an economy, not necessarily part-time. It's very weird. I'd love to know what you guys think down below in the comments. I think that we're in for a really bumpy ride. Like, things are going to get worse, whether it's artificial, whether it's on purpose, whether it's done by accident. I think things are going to get worse, whatever the reason. And the closer we get to an election, the more promises you're going to get from the Liberals. We are the ones that are going to be able to fix it. We are the ones that are going to provide the solution. We're going to bring interest rates down. It's not because of us and our mismanagement. It's because of the unsolicited or the illegal war of Russia on Ukraine and the whole pandemic thing that happened, right? It's not our fault. It's a global recession. They're going to keep trying to sell that to get more votes to try to increase their, their confidence, or the confidence that people would have in our current government. And I don't think that it's going to work. I think people are past that line of no return with their anger and their frustration with the Canadian government. And once you kind of breach that trust, there isn't really much that you can do to regain it. Well, I'm going to have to see how this plays out. But I'd love to know what you guys think down below in the comments. That is where we're going to end this video. On your way out, I would like to encourage you guys to smash the like button, subscribe if you haven't yet already, and I'll see you all in the next one. Bye for now.